Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at Warren Buffett's top 3 dividend paying companies you can buy right now for under $50. Warren Buffett, the Oracle of Omaha, is one of the greatest investors of all time, and he loves dividend paying companies. Buffett is the CEO of Berkshire Hathaway, a company he founded more than 50 years ago, and he's built it to become one of the largest organizations in the world, currently worth over $626 billion. And within Berkshire, he invests hundreds of billions of dollars into blue chip dividend paying companies. And we're going to go over the top 3 stocks in Berkshire's public equity portfolio that provide a growing dividend year after year and currently trade for below $50 a share. And right away, dividends I believe to be one of the best forms of passive income. Once you make your initial investment and you buy into a strong blue chip company with continuous operations, you can collect that growing cash flow year after year without doing any more work, which is a great sign. And overall, I built up my personal dividend portfolio to over $100,000, full of only blue chip dividend paying companies, and I love the results I've been seeing. So overall, Buffett, he's outperformed the market over the past 50 years, one of the greatest investors to ever live, and we're going to focus on his top 3 picks within his portfolio for dividend paying companies currently trading below $50. But before we jump into stock number 1, I'm going to ask you to please hit that like button and subscribe. I'm the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy, and any major market news. So please hit that like button, subscribe for the daily videos. And the first company we're going to go over that's actually the second largest holding in Buffett's public equity portfolio is ticker BAC for Bank of America. They currently trade for $40 a share and are up by 75% on the 1-year chart. This is one of the largest financial companies in the world, and Buffett is a key shareholder. And throughout the 2020 pandemic, when the entire financial sector saw a major decline in share price, Buffett was a huge buyer and invested billions and billions of dollars into Bank of America stock. And he started buying the company throughout May, June, and July of 2020 when they were trading between $20 and $24 per share. And we can see back in July of 2020, for example, at the $24 price point, the company is now up more than 66% to this $40 level that we sit at right now. So Buffett has already seen some incredible share price appreciation from a blue chip dividend paying company he bought during the dip of the 2020 pandemic. Buffett believes in the financial sector, and he has Bank of America as the second largest position in Berkshire Hathaway's public equity portfolio. He owns more than 1 billion shares of the company, and with the current market price just over $40, that equates to a total market value of over $41.3 billion into this one single company, and that makes up around 12.1% of the entire company's ownership. So he owns over 12% of Bank of America, and it's the second largest position within his public equity portfolio. And we can see this company is doing a lot of good things for its shareholders. They announced a $25 billion stock buyback plan throughout 2021, so they're returning a ton of excess capital to their investors, and the company plans to buy back around 7% of their outstanding shares. Some other good news with Bank of America is the fact that the company has just raised their annual dividend after the Fed reduced the restrictions, and they actually grew their payment by a massive 17% on a year-over-year basis. And of course, throughout 2020, the major banks were not allowed to raise their dividend because the Fed put restrictions in place due to the risk of the pandemic hurting the financial institutions. But after the latest stress test, all the banks passed with flying colors, they're in very healthy financial positions, and they were allowed to do major dividend increases, and we can see 17% growth in that passive income coming from Bank of America. So now if we take a look at their dividend scorecard, the current yield on the company is actually above 2%, with the annual payout now being 84 cents per share per year. So when you include that new payout with the current share price, your dividend yield when you are to buy in today sits at above 2%. They've maintained a very low dividend payout ratio, only around 23% of their net income with the old payment, and the 5-year dividend CAGR, even including 2020 where they did not grow their dividend, is still at a massive rate of around 29% per year, which is absolutely incredible. And if we take a look at Simply Safe Dividends, the company has a current dividend safety score of 55, which is considered borderline safe. But overall, I have discussed this on the channel many times. I do think this score is very low and think they will be upgraded to a safe rating very soon. After the Fed's latest stress test, they said the banks are in some of the healthiest financial positions they've ever seen. So I think Bank of America is very strong. I think the company is going to have nice growth in their net income going forward. They just announced some major share buybacks and a major dividend increase, and they would have not done that if they could have not sustained their previous dividend level. So I think right now the dividend is considered safe. I think the income and the cash flow will continue to grow going forward, and I'm not worried about a dividend cut coming from BAC anytime soon. And if we take a look at some future growth projections according to Wall Street, they're forecasting 24% expansion per year for the next 5 years going forward, coming from Bank of America. And at this current level, the stock is considered a light buy, coming in at a 2.3, and the current share price of $40 is below the 12-month expectation of around $43 to $44 per share. So overall, Bank of America is the first dividend paying company you can buy right now for under $50. It is one of Warren Buffett's favorite stocks to own, the second largest position in his public equity portfolio, making up 12.1% ownership in BAC, worth over $41 billion. So this was stock number 1 for this episode. And now if we jump into stock number 2, it's going to be ticker KO for Coca-Cola. They currently trade for $54 per share, which I understand is above the $50 level, but only slightly, and the company is up by 24% on the 1-year chart. They have a market cap at $233 billion, a forward PE ratio right at 25, and a nice dividend yield above 3%. Warren Buffett is highly associated with Coca-Cola. He's been a key investor in the company for over a few decades and loves this brand. He has no intention of ever selling out of the company and plans to hold pretty much forever. Coca-Cola is a company that's been a staple in our society for over 100 years, and we can see they own many iconic and recognizable brands all around the world. And under Coca-Cola, they have more than just the soft drinks. They have different water and hydration products through Dasani, vitamin water, Powerade, and many more. They have different juices, dairy, and plant-based goods, as well as coffees, and even now teas. So overall, the company as a whole has multiple different products. They're the number 1 brand in the drink and beverage sector, and they dominate all around the world. And Coca-Cola, even though they're a massive company, they're a dividend king. They've been operational for over 130 years, and they still have very strong plans set in place to help the company grow and expand for many years going forward. And if we take a look at their latest investor presentation, Coca-Cola does a great job of generating revenue from all around the world. Their net revenue came in at $33 billion over the past year, and that can be broken down from Europe, Middle East, and Africa, making up 18% of the total top line, Latin America at 10%, North America at 34%, the Asia Pacific sector at 14%, then they also have their global ventures, making up 6%, and their bottling investments, which are actually located all around the world as well, coming in at 18%. So nicely diversified revenue coming from many different geographical areas. And the cash flow they generate from their operations is split into 2 main uses: investing for growth and returning capital to shareholders. So of course, for dividend investors, we like the return to shareholders, and they do that through a growing dividend, and Coca-Cola is a dividend king, so they've actually been growing their payout every single year for 58 consecutive years, which is very impressive, and they plan to maintain a payout ratio right around 75%, and then if they have some excess cash flow, they will also do share buybacks. And of course, investing for growth is reinvesting back in the business, coming out with new products, making acquisitions, and growing the company's operations. So overall, going forward, they can create more cash flow so this entire cycle can continue. And if we take a look, over the longer term, they still believe they can grow organic revenue around 4 to 6% per year. They believe operating income can grow 6 to 8% per year, and EPS to expand by 7 to 9% annually for long into the future, which still be a very good sign. And if we take a look at their free cash flow, they believe they'll get a 90 to 95% adjusted free cash flow conversion ratio, which once again would be very good usage. And if we take a look at the dividend scorecard, coming in with a yield at just above 3%, a current dividend payout ratio at around 75%, so right near their average target, and a 5-year dividend CAGR of 4% overall, so not the fastest dividend growth, but slow and consistent coming from Coca-Cola year in and year out. And currently, the dividend is considered safe, coming in with an 80. And going forward, analysts are expecting around 9% annual expansion in the company, plus the 3% dividend. You're looking at a nice 12% annual growth coming from a blue chip, boring, dividend-paying stock. And right now, we can see they are currently considered a buy, coming in at a 2.2, and the current share price of $54 is below the 12-month expectation that sits just below 60 on average from 23 different Wall Street analysts. So overall, Coca-Cola is one of Warren Buffett's top holdings, and Berkshire Hathaway has been a key shareholder in the company for over 30 years. And we can see ticker KO, Warren Buffett owns 400 million shares of the company, and with a current share price of $54, that equates to over $21.7 billion he has invested in Coca-Cola. He bought in a long time ago. Most of this is unrealized gains because of the growth in the stock. And right now, he owns 9.3% of the company, which is a major position once again. So the fourth largest holding within Berkshire's total public equity portfolio is Coca-Cola, and that's the second blue chip dividend paying company you can buy right now for around $50 per share. I understand it's slightly above, but it's close enough. And now if we move into stock number 3, it's going to be ticker VZ for Verizon. They currently trade for $56, so once again slightly above the $50 mark, but still a very reasonable price point in terms of actual share price. Even though that doesn't matter in terms of growth and valuation, many investors like to buy companies that they think are cheaper just because of the dollar value of the share price. So we can see Verizon is up around 4% on the 1-year chart, so pretty much flat during the past 12 months. And we can see they have a market cap at $230 billion, a very reasonable forward PE ratio just below 11, and an absolutely massive current dividend yield at 4.5%. So I own this company in my personal portfolio as well. This is purely a high dividend income producer. You're not going to get a lot of share price appreciation from this company, and a bulk of your total return is going to come from the current cash flow. And with Verizon, this is a newer addition to Berkshire Hathaway's portfolio. Buffett created a major position in the stock in late 2020 and early 2021, where he invested close to $9 billion into the major telecom giant. And if we take a look at Berkshire's overall portfolio, we can see that it now sits within the top 10 overall holdings. He owns 158 million shares worth $8.9 billion, which represents around 3.8% of the entire company. So for a newer addition to his portfolio, Buffett does not go in slow. He started a major buy, invested close to $9 billion, and he bought in close to 4% of the entire ownership stake within Verizon. So I'm sure he believes in the telecom giant long term, and I'm sure we see some future growth coming through the expansion of 5G. And if we take a look at Verizon's latest quarterly report, the company did a great job starting out 2021. Total revenue came in the first quarter just below $33 billion, which was up 4% year over year. And if we take a look at their cash flow, that saw some major growth over Q1 2020. Cash flow from operations came in at $9.7 billion. They spent $4.5 billion on capital expenditures, leading $5.2 billion in total free cash flow, up from only $3.6 in the prior year. They paid out half of that in the form of the dividend, so maintaining a free cash flow payout ratio at only 50%, I believe to be very sustainable, giving the company a lot of room to pay down debt and grow the business, while also giving them a lot of excess capital to actually grow that dividend going forward. And if we take a look at their income statement, over the past 5 years, they've generated very consistent revenue. Total revenue averages between $125 and $132 billion. So not a lot of annual revenue growth, which of course isn't the best sign, but what really shows that this company, even throughout the pandemic, did not lose revenue. In 2020, they generated around $128 billion of total revenue, which was down very slightly from the prior year and has picked up over the past 12 months. So overall, I'm not too worried about this company over the shorter term. I think they continue to generate consistent revenue going forward, and they're strong business. They operate in an area where people do not want to cancel their subscription to Verizon, and overall, I think the company will continue to generate some growing revenue for long into the future. And if we take a look at their dividend, an absolute massive yield coming in at 4.5%. They have a very reasonable dividend payout ratio coming in at 49% and a 5-year dividend CAGR at 2.1% per year. And if we take a look at Simply Safe Dividends, it comes in at an 87, which is considered very safe. So right now the company does pay out a dividend that's considered very safe and very unlikely to be cut anytime soon. And like we saw from the investor presentation, the nice 50% free cash flow payout ratio, that income payout ratio made it right around 49%. Overall, the company is looking to be in a nice, strong financial position. So overall, those were 3 companies that were in Warren Buffett's top 10 public equity portfolio holdings. They all trade for around or below $50 per share and provide some growing passive income every single year. Buffett must believe in these companies if he's given them such a large weight in his portfolio, and in total, Buffett only owns around 30 different equities. So he's very specific on the companies that he likes to own. He doesn't believe in quantity, he believes in quality of the businesses. So he buys strong, high quality companies, and I think that's what he's done with the 3 names we've gone over in this episode. So overall, definitely take a look at them if you want to invest like the Oracle of Omaha, 3 companies worth adding or taking a look at for your own portfolio. So thank you for watching all the way to the end. I'm going to ask you to please hit that like button and subscribe if you already haven't done so. And as I wrap up the video, I will see you in tomorrow's episode.